Okay guys, welcome to Key Equity Hedge update 20th November 2009. Previous session we were naked in the market until we got this short, remembering that our spreads we're right smack bang in the perfect position in the middle of our spreads with about 18-19 days to go with our expiries. So we got into a short for the hedge, for the futures hedge, and that stopped straight out, so then we're looking for another trade. So we're looking for the market to either pierce through a green cross for a long or go back through the red cross back short again for a short. That doesn't happen until here, which is the 18th of November at 1926. Just put that in there. 18th of November at 1926 is when we got the entry. We'll just double check that double check that 18th at 1926. That's right. So that triggers not long after it around this area. So we got our signal. We didn't get another, well, it's about the same there anyway. So any one of these red crosses are about the same. So then when we enter into that trade, what do? Well, we just start monitoring that with our stop. So that's our stop above there. So I'll just make that red so you know that that's the stop. And I'll make this green so you know that we got in to go short there. And put that like that. So we got into that trade there. So now we're short with one large S&P. So the reason that we hedge is because if this market was to really drastically sell off and to go through our strike points, well, oh dear, we're in a lot of pressure with our positions. And usually with it's your typical option setup, well, you'd drastically lose money on your options hedge or your options account. So now that we've got the hedge, so we're making profit along the way. So we're short here from where were we? The short entry is 1100, about 1100. So to get down to our strike points, if there was a major sell-off, we're way down here at 950. So already, before we get there, we've accumulated 150 S&P points if that was to just sell straight off. So that's our hedge. So we've got that covered with our options. So you're making 37,500 on the way down. So if your options are under pressure, well, if you're losing on your options trades, well, you've made that money on the futures. So we're hedged. That's why we call it the key equity hedge. So that goes down there and sells off quite a bit last night. We had unemployment news out, so that's I'll tell you how much that's made. So we're just coming down this yellow dot. Now that's the stop. So when we're short, our stops there on the yellow dot. You just press there and it'll give you the stop here on TradeStation. 1107.50 is the start. So you press it again, it just keeps coming down as the market sells off. Well, it's just tightening up the stop. We keep coming down, so we're in here. We keep coming down, so now we're in profit. And we just stop out there. So the yellow dot was 10.95. So you'd go at 10.95.25 or 10.95 as your stop. However, the high of that was 10.95 there and 10.95.25. So we're out of that trade 10.95, I'd say. So we'll just write that in. So we got out at 10.95 and we're in 11. I'll just double check that. So we got in at this on that candle there, so 1150. So 1100.5. So we've made 5.5 points on the way down. So we just comfortably. That's what you call a hedge move, and you're grabbing profit on the futures as well. So our options are still in no danger. We just picked up 5.5 points on that run down. So now we're back to about 500 down on the futures with about 17 days to go. So these accounts are still sitting pretty at about 50% each. The $100,000 at 50%, 53. Same with the 500s, about 55, and same with the $1 million account. $25,000 one's about 42%. So that's the update for today. We're coming into the Friday session, so one last session before the weekend. So we're looking for another update tomorrow, and then we're looking for another 2.5 weeks heading into the Christmas period until these options expire on the 17th of December. So thanks for joining us.